The Nigerian banking sector is in the midst of a significant transformation driven by the Central Bank of Nigeria's revised minimum capital requirements. This recapitalization drive, with a 2-year deadline ending March 31, 2026, has far-reaching implications, not just for the financial institutions themselves, but also for stakeholders, investors, and the broader Nigerian economy. Beyond the diverse strategies banks are employing, Governor Cardoso of the CBN emphasized stricter scrutiny and tougher conditions for banks participating in the recapitalization. Joining me for more on this is Tajudeen Ibrahim, Director, Research and Strategy, Chapel Hill Denham. Thank you for joining me today.
Thank you so much, Perpetua, for having me on the show today.
All right, so talk to us so far. What are the predominant strategies banks seem to be adopting, and what are your thoughts about them?
So in terms of the recapitalization exercise by the banking sectors, what the banks are doing is to consider raising equity capital, because the equity capital raise is the major component of the requirement of the capital, increase in capital, as stated by the central bank. And one key element around that is that this time is different because all the banks in Nigeria have to recapitalize. Largely speaking, because the benchmark, has changed. Also, what has changed is the licensing and also the required level of capital. So to be international bank, for instance, you have to have 500 billion naira minimum capital. And the capital we are looking at in this case is your share capital and share premium. So which makes nearly all the banks need to raise capital in that regard. And what they are doing is to go via a rights issue for many of the banks. Some of them are even looking beyond equity capital. They are looking at debt capital, and this is where we stand currently in the industry and in the markets.
I don't know. What do you make of debt capital? Is it something you think is a good idea?
Debt capital is a good idea, particularly when you look at it from a capital adequacy ratio standpoint. The current capital requirement is not around capital adequacy ratio. It is more around ensuring that the banks shore up their capital in readiness for a $1 trillion economy for Nigeria in terms of the size of economic outputs from the country. But when you consider capital adequacy from a capital adequacy ratio perspective, raising debt capital is supportive of meeting some certain threshold set by the central bank. So that this is where raising debt capital makes sense.
Tajudeen, let me come in here. My concern really is the risk associated with that.
Sorry, what did you say?
Okay, I said my concern is the risk associated with that. I would like you to speak a bit more on it.
Well, the risk associated with debt capital is not so much of a major concern when you look at the Nigerian banking sector as a whole. This is a sector that is strong and well experienced around raising debt capital. In the past, we have seen them raise debt capital in naira. We have also seen them raise debt capital in dollars as well. So we have a good history with respect to raising debt capital in the country as far as the banking sector is concerned. So I think it is supportive of the overall capital adequacy ratio, as it will help the banks to meet their respective limits. For systemically important banks, for instance, 15%, 16% looks like the level, and if they raise debt capital, it will underpin their ability to achieve that target.
Right. So we're sort of trying to break this conversation down as much as possible, especially because we feel every Nigerian should know what this means. Could you break down these strategies, whether it is the rights issue, or the public offers, private placements, or even the debt capital you just talked about, which of course has to do with going to the debt markets to raise funds? That's like borrowing a loan. So talk to us about some of those things, what they mean basically, so we can carry more people along.
So let's start from equity capital. Equity capital, requirements for the banks based on what they have announced. So far we have heard banks wanting to, raise a total of 1.7 trillion naira. There's a chart that can be displayed possibly that shows, how much has been approved so far by the shareholders, of the banks, that have indicated plans to raise capital. So in total, it comes to about 1.7 trillion naira in terms of equity capital. And they are doing that, adopting a strategy of a hybrid offer for some of them. That is a situation where they have a rights issue and also they also have a public offer at the same time to ensure that they are able to raise the right size of equity capital. We have not heard from all the banks, but some of them, will announce, very soon. The second, thinking around the capital requirement is the possibility of mergers and acquisitions. We most likely are going to see some banks that cannot raise the level of required capital to uphold the kind of license that they currently have. They, of course, will have to either scale down to a regional bank or a national bank, or they consider, merger and acquisition to ensure that the entity that will emerge will be, larger and stronger to withstand economic risk.
Tajudeen, we'll continue from there. We need to take a break now. When we come back, we'll continue. Stay with us. You're still watching Business Edge, and just before we went on that timeout, I was speaking with Tajudeen Ibrahim, the Director of Strategy and Research at Chapel Hill Denham. Thank you once again for staying with me, Taj.
It's my pleasure.
All right. Before we went on that timeout, we were talking about the possibility of, having M&As and all of those things. So talk to me, as an industry watcher, what do you know about, maybe banks that are considering M&As, license step down, or any of those inconvenient options?
Well, I think it is too early for me to, publicly, speak to specific names in the sector. No doubt there are works, going on, in the pipeline around, the possibility of M&A transactions. But the reality is that not all the banks in the sector will be able to, raise the level of required capital, within the next, 2 years. Most likely, some of them will have to, adopt an M&A strategy. For those that will possibly step down on their licenses, I think it is also too early, in the exercise period to begin to, mention specific names. But, I have a sense around, those that are possibly going to consider, stepping down. Because when they step down on their capital, level, what it does for them is that it allows them to focus on national license, if that is what they want to scale down to. It allows them to focus on regional license, if that is what they scale down to. The first chart that is displayed on the screen earlier, that first chart is an indication of the level of the capital planned to be raised. If we look at Fidelity, for instance, we recognize that they are in the market, and this first slide basically speaks to as high as 500 billion naira, for GT Bank, for instance, and as low as 127 billion naira for Fidelity, which is what they have announced that they want to raise in equity capital. So we have not heard from UBA, we've not heard from First Bank, we have not heard from Zenith Bank. So we still have those three large banks have not indicated how much they want to raise from the equity capital market. But in due course, my sense is that they will announce. But all these numbers we have on the screen, they are an indication of what will be raised in equity capital within the next few weeks by some of these banks. Fidelity Bank is already in the market with a hybrid offer. They are doing a rights issue at the same time they are doing a public offer, but we have a bit of concern around, the ability to raise up to 500 billion naira. But the message is that we like Fidelity Bank. We believe it is a buy. We believe investors, should take their right. We like the fact that it is at a discount to the current market price, between 4 to 9% discount. That is where the price of the rights issue offer is, and also the public offer. So we like them on those two fronts. We also like the fact that Fidelity Bank is a very strong bank when you look at the metrics relative to the tier 2 banks in the country on average.
Well, considering the potential dilution from the rights issue, how can existing shareholders sort of assess the overall value proposition of participating in the offer? And, beyond the immediate discount, which you also alluded to, are there other benefits existing shareholders should sort of consider when deciding to exercise their rights?
Honestly, there are enormous benefits in what the shareholders can get when they invest in the offers of these banks. If we're talking about the dilutive impact of the rights issue, one thing we have to bear in mind is that the dilution happens only in the first year. And after the first year, what you'll be seeing is accretion to the earnings per share. And that will also come with much higher dividend per share for investors. So I think, investors investing in these banks should take a long-term view at, the opportunities that will come to them. Investing in shares or in stocks is not something that should be short-term in nature. It should be more like a medium to long-term in view. So when we consider Fidelity Bank, for instance, when you buy into the rights issue, no doubt in 2024, there will be a dilutive impact. But from the first quarter of 2025, you will begin to see the accretive impact of the capital raised on earnings. And what that implies is that if there is an interim dividend to be paid, it will come much higher. Then the final dividend to be paid will also come much higher. These are some of the benefits that Nigerian investors and even foreign investors, can expect to get from Fidelity. I said it earlier, displayed on the screen, we have much stronger, operation numbers by Fidelity Bank. Net interest margin, much higher than the industry average, talking about the tier 2 peers. Cost to income ratio, lower than the industry average. Return on equity, much stronger than the industry average. Dividend yield, more compelling at 8.6% compared to 7.4% for the tier 2 bank, on average. So we like Fidelity Bank on all those fronts, and we believe investors, should take advantage of the current offer in the market.
What about the concern about maintaining its international license?
So the concerns maintaining the international license is valid because we reckon that about 243 billion naira will be on the cards, for them to raise, in addition to get up to 500 billion naira to maintain an international license. For now, Fidelity Bank has not communicated to the market, but we know that they have a UK bank that they acquired, very recently. My sense is that they wouldn't like to let go of the UK subsidiary, so there will be another round of capital raise by Fidelity. That is my view.
All right, now there are concerns in some quarters about, how the overall health of the domestic capital market might sort of impact the success of these fundraising efforts. Does that bother you?
So it does not really bother me, because if we look at the market as a whole, you will agree with me that the market is not, the investors are not really taking advantage enough of the opportunities in the market. Let's talk very briefly about the pension industry. The pension industry has around 20 trillion naira, in assets under management. If they expose just about, 10% or thereabout, of that to equities, that is not enough. They have to go to as high as like 15%. And I think there will be opportunities for the banks to be able to be successful in their capital raises when we have, pension fund administrators invest, in those offers. And I think, that is where we are looking at in terms of where would the flows come from. Let's take a look at the second leg of the market, which is the retail segment of the stock market in terms of investor base. The retail segment is also rising in terms of their activities in the market. So I reckon that the offers in the market by the banks will be successful on the back of rising retail investor base, and also a pension industry that is currently underweight in equities. They would have no choice than to increase their weight and exposure to equities for future benefits.
Definitely. Now, I'd like to continue by saying, do you see any of... Great. We'll just move on from there. Do you see any of the listed banks having any issue raising this capital within the stipulated time, without necessarily having to succumb to M&As? I'm talking about the listed banks now because they sort of, they have some advantage.
I think for the tier one banks, largely speaking, Access, Zenith, UBA, First Bank, GT Bank, I think there should be no issue at all around, raising the level of, capital that they need. Those are very strong, and they have a very strong investor base, in my view. I think where we could find challenges are the tier two banks, down to the tier three banks. I think that is where the challenges could be around, raising the required size of equity capital that they need from the market. And it is in that space where we expect, M&As to materialize. And it is in that space that we expect some level of scale down of license from either international to national, from national down to regional. I think the tier one banks are strong, and we should only watch out, for tier two.
All right, so we should watch out for tier two. What about those that are not even listed
banks
at all?
In terms of of licensing.
Okay, just
those that are not listed, I think, for those that are not listed, you will find a lot of M&A and scale down in that space as well, because they're not listed. So it is a downside for them, in my view.
Right. Talk about the potential long-term implications of this recapitalization exercise for the competitiveness and growth prospects of Nigerian banks. I'd like you to just speak to that before we go.
So the Nigerian banks will grow on the back of the recapitalization. Why do I say so? I say so because, number one, it gives them the opportunity to take advantage of lending opportunities in Nigeria. Number two, it gives them the opportunity to take advantage of, the growth opportunities in Africa for those of them that have international licenses. And there are some of them that also play beyond Africa, like Access Bank. A much stronger capital base for Access Bank implies an ability to play a lot more in Africa and beyond Africa. That will be earnings accretive in the medium to long term, in my view.
All right, just before we go, I need to talk about this. Is this capital raise of banks enough to actually drive $1 trillion economy? I mean, if the capital is raised and we still have elevated interest rates, poor power, infrastructure, bad roads, insecurity, and all of that, isn't that sort of going to make this whole drive of little or no effect?
Maybe we should take a look at, beyond Nigeria. Let's take a look at our, peers in Africa. Nigeria is currently one of the countries where core banking capital is low. We have, a high level of, capital in South Africa. So one should not be surprised that that economy is a lot more advanced. We have high level of capital in terms of core banking capital in Egypt. One should not be surprised as well. So we have Nigeria sitting like at the bottom. If you were to rank us in the top 10, the first bank you'll find in Nigeria.
Okay, I guess we will just have to wrap it up here. Thank you so much, Tajudeen Ibrahim, Director, Research and Strategy, Chapel Hill Denham, for your time on the show today.
Thank you for having me.